Welcome to the latest episode of High Stakes. I'm Paige Soya, Managing Director of K Street Capital. And today's episode is focused around one of our longtime investors and LPs, Sara Fagen, and her many, three ventures now that you've been involved in, both venture backed and not, and what those exit experiences, what the learnings were from them. So thanks for being here, Sara.
Yeah, thanks for having me.
Before we get started, why don't we just do a quick intro, share a little bit about your background, which is somewhat unique in terms of going from that to starting a tech company, and then we can get into some of the exit stories.
Yeah, if you would have asked my 18-year-old self if I would be a tech entrepreneur, I would have never, that would have been the farthest thing from my mind. I was a political operative. I mean, I love campaigns, I love politics. I grew up in Iowa. I had the fortune of close proximity to the Iowa caucuses. So I got involved early and got a lot of responsibility young and ended up in the Bush administration. I worked in both George W. Bush administrations, but in the second term as the political director. Prior to that, between the two campaigns, two administrations, I worked on the reelect and managed kind of two initiatives in the paid media department, essentially. One was digital advertising, which in 2004, persuasion digital advertising,
Mm-hmm.
yeah, which in 2004 was not really a thing. There was no social media, but the internet was being used for fundraising and certainly for search. And so the question was, could we do more, and put budget against digital ads to try to convince voters, to vote for our candidate? And we had like $250,000 budget and we couldn't really get it to work. And it took a month to get results. And like, we just threw our hands up and put the money on TV, which is like crazy today to think about. And the second initiative was around micro-targeting. We could do a whole podcast on why that was necessary, but I'll skip the details. That and the point of it was to get a much more data-driven approach to who is likely to be supportive based on specific issues, who is likely to turn out, and how to score that. And I remember in my office thinking, these two things will come together. There will be a point at which that micro-targeting initiative meets the digital world. And if you can figure out how to do that, you're going to be very successful. And so, in the back of my mind, even though I was still focused on politics, went into the White House, like that was always in the back of my mind. And that's really where my tech experience has been, since leaving government now 20 some years ago. In one way, shape, or form, I've been thinking about working on doing that.
Very cool. And I know maybe talk about your first company was venture backed. And I know maybe talk about that for a second, just how it was generally capitalized, how long you ran it, and what was the time period when you sold it.
I actually started two companies at the same time. And the first was, and part of that was leaving government and I was broke because I worked on a government salary for many. So I needed to make money, but I had this vision of what could be done by putting these two things together. And I had met a businessman named John Brady, who's a very successful entrepreneur in his own right. And he was interested in exploring that and how do we make it work. And so teamed up and figured out kind of how to start a process to consider. And that became Resonate. We hired some professional management who were very good. But I was also making money at the time. And anybody who's built a tech company knows you don't go into it and pay yourself a big robust salary. Like you throw everything into business. So Resonate started really as an idea in 2000, late 2007, early 2008. And we had hired a consultant and we were kind of thinking through it. We used a lot of DDC, which was my second company. And I came in kind of midstream into that venture. But, we used a lot of their resources. They were big backers. They were also funders early on until launched it. And so, public launch was 2009, and we sold to PE in 2022, excuse me. Yeah. So it was a lot. It was
12 years.
yeah, not an
13 years.
atypical journal. That's not atypical,
Mhm,
but people who have exits in 4 or 5 years, that's I think more atypical. But
mhm.
every every tech entrepreneur is going to make billions of dollars in 5 years. So I think overall it was a pretty good trajectory. But it takes a decade usually to build something in Dormant.
Exactly. Yeah. I think people don't realize that. especially now, and things go public later and timelines are just extended. But that company, you raised venture funding through like, what was it, a Series C stage type company?
So we actually did rounds through round D. Yeah, and so we had significant venture money in that. It was an interesting experience. Like it's a very cool company. It still exists today. I'm no longer a part of it. A lot of some of the same people who built the business, are still there running it, and I have no doubt that they'll have a very successful second act.
And maybe talk about who bought it, why they bought it, and like, were you ready at the time to sell it?
We were definitely ready to sell it, and I think some of this gets into so the acquirer was ZMC, and that was a very good experience. I wasn't, by the time 12 years later, 3 other companies, I was on the board, but I wasn't day-to-day management. So I wasn't super involved in it, but I remember meeting with them, going through the banker process with them and a couple other, interested parties.
But
Uh,
you were still one of the largest stakeholders at that point, I would think.
I wouldn't I was one of the largest individual stakeholders for
Okay.
sure,
Yeah.
I mean, certainly by the time we had raised, there were much bigger stakeholders than me or any of the other employees. Yeah, I mean, it's interesting when you think about raising money, I think it depends your vantage point as to what your attitude toward this is. And when we started Resonate, I mean, I knew nothing. I did not know how to read a PM. I did not. I mean, I was a political person who knew a lot about survey research. And so I had to learn as I go. And I think a lot of times, I mean, venture backing is critical. Obviously, it's critical capital. It can be very good. Like we had very good venture funds in Resonate, great backers, but well-known brands. But sometimes I think companies raise too much money, right? Like that you get very lofty and you have to start to prove what the exit
Why that valuation is gonna be that. Exactly.
look, you've got to build those plans. The funds demand it. But, DDC, I had a small company as I was starting to build Resonate. That was my cash generating company. I rolled that into DDC in part because of the strong partnership that we had developed together as we were sort of thinking through the beginning stages of Resonate. And that never took venture money. There was some money raised at one point. I had built a book of business that I rolled into it. So that was technically an acquisition that had, increased the valuation of the company. So they did it, a
The creative.
solution to grow the business. But when I think about the exits, the DDC exit was incredibly successful for everybody involved, in part because there was nobody taking money out of it at the time.
Right. There
So
wasn't any dilution. There wasn't like a lot of investors to pay back at the time when that happens.
right. So, when you take a lot of venture money, you need a really big exit for it to make sense. And at DDC, we had a bigger exit at Resonate than we did at DDC on top line, but the individual
Right. The once it water flowed down to the
right,
middle.
the sweat and tears people did better,
Right.
and so it is an interesting vantage point to watch that over the course of a few years.
Yeah.
And it's definitely educated me about don't always be attracted to this shiny object. It doesn't always
Mhm.
mean it's going to be a good outcome for you.
Yeah. Yeah, exactly. Made the same mistake myself with my first venture. I think a lot of people do. I was like going to say, your background being in policy and politics and the campaign research, going into having a venture backed startup that you took all the way through Series D and had a positive, it was a cash exit, I assume, or maybe it was equity or some combination. How did you learn all that stuff?
I mean, so when I was leaving the White House, so I was the political director, which is a reasonably senior job. I traveled with the president. And, I had like this very high profile position in Washington. And I was really young, I was like 30. I think I left the White House when I was 31 years old. And so I didn't really know what I wanted to do. I knew that I wanted and frankly needed to make money, but I couldn't really imagine trying to recreate that experience. I think a lot of people in campaign politics, this is probably true in business as well. Like you have this great experience, outcome, dream team comes together, like you do something amazing. In our case, we had lived through a lot of very difficult things, 9/11 and policy and the election, dynamics that really seemed very calm now comparatively. But at the time, there was a very contentious, campaign in 2004. And it's like I just knew that it would not be able to recreate that. And so staying in politics didn't make a ton of sense to me. That I'd just be chasing the last dream, chasing the next Super Bowl
Yeah.
felt wrong, but I didn't know that much about business. And I had a group chase after me to run their actually the trade association. And I kind of like stubbed my nose at it. Like I didn't want to run a trade association. Like that seemed kind of boring compared to what I was doing. And then I learned what those folks make. And then I was like, well,
You're like, well, maybe.
that was really dumb that I didn't want to look at that. So I went and took the hard path, which is to go build a book of business. And I just started doing it kind of accidentally. And I made a few wrong turns and took clients that I wasn't the right fit for, but ultimately figured it out reasonably quickly. And I never thought I wanted to have to be my own boss, like responsible for my own money.
Hmm.
And so when I was leaving the White House, I actually almost went to business school.
Yeah.
And I worked in the 96 cycle for former US Senator Phil Gramm, who was running president at the time. And I had kept, it was a small team, and I had kept in okay contact with him. And so I called him, and he was the vice chairman of UBS at the time. And he was very good. He took my call and gave me advice. And I was like, asked him to write a recommendation. And he literally said, that's the dumbest thing I've ever heard. Why would you go do that?
Go to business school.
Yes.
Yeah.
But your Rolodex is worth millions of dollars. Go use your Rolodex. Don't go to business school. And it's in many ways, like Resonate for me was business school. That's where I learned it. I had to learn it on the fly. And I'm sure at times text some of the people around me are like, that's a dumb question, but I learned it. And, frankly, I had a great idea and a bunch of people made a lot of money off of it. So it was a
Success.
success. Yeah.
Yeah. And maybe talk about why did the buyer that bought you, what was the reason they wanted to acquire Resonate? And I assume they still own Resonate today. Is that
Yeah.
right?
Do. So I can't speak for them, but I know if you sort of think about convergence of audiences, connected TV, digital advertising, which are still fast growing spaces. The move from, I'm just talking at a high level, these aren't their specific reasons, but at a high level, linear TV is declining, but certain parts of it are going to probably increase. But to match TV buying with digital buying, on TV, I mean linear buying with digital buying, you need to have an impression. So the whole, all the economics are changing. And so what becomes very valuable, and this is the audience, because in the old days, there were three networks and you just bought all three networks and you got 100% of the people watching. And as media consumption has fragmented across streaming platforms, but even ironically, local TV is going down, but local content in large markets is actually increasing. So as the networks, don't need to fill as much time or won't over time fill as much time, more time will go back to the locals. So you need so much more data to do this smart. And there's more opportunities to actually find people today than there were 10 years ago, but it's harder to find them.
Mm-hmm.
So, at a high level, there are a lot of people trying to put that all together and figure out the right mousetrap to.
Mhm.
And so in the case of PE, you've seen a number of large PE firms, think through how they would roll up a lot of these different platforms into one mega decision intelligence tool that can allow advertiser to utilize the data and then place and execute the buy through that platform. And
Right. Okay. So they were buying other companies at the same time.
yeah, I mean, they're a very large fund and, I don't know exactly what their strategy is and who they may or may not have looked at, but it's, I could just sort of say broadly speaking, like that's a trend in the PE world that is like, let's put a bunch of these assets together, build a very big company that serves the Nielsen is declining, the holding companies, have their challenges and the technology you can do so much more, in a reasonably smaller tech company and have potentially a very, very large outcome.
So maybe talk a little bit about the timing and the environment when you sold because it was 2022, right?
Yeah, it was 2022. And so in hindsight, so the market kind of started this is one of the great things where, so Q4 of 21 was the heyday, right? Like that was the crazy multi when people were coming to us with 20X K Street and everywhere else. And so in hindsight, we were a little late, but it works out the way it works out timing wise. And I remember thinking we should be doing this now, but there were other people working more diligently, like day to day on this, that had a different view. And
Yeah.
one of the views was it's so busy and crazy, like we'll get more attention going out in 2022. And that may or may not have been true.
In reality, yeah. Yeah.
Who knows? But hindsight is always 2020.
Worse.
But yes, like timing it would have been better. But you also have to be at critical thresholds when you sell these businesses or when you
Exactly. You can't and you don't know when you're at that threshold. It's whatever year it is, you know. But
A lot of times, getting to 20 million of ARR like opens up a whole category of people. And so, raising capital, you want to be, if you're going to a growth fund, like one of the things I've learned in this current venture is like, I really need to be at 10 of ARR is
mhm,
probably where I need to be before I attract the right fund for me. And so, that's just sort of a learning that's really not true. That some funds will invest at you less and some will, but you get into a weird spot as a business where you're too big for one
yep,
category and you're too small for another. And so I think right now we're, like that's just something you have to learn on the job. I feel like,
yep.
people go through it in business school, but I think you learn.
You learn the reality when you've been
Yeah.
through enough exits or you've done self and
Conversations with funds and, five of them tell you the same thing. And you're like, okay, well, that may or may not be like prudent advice. That may or not be smart on their part, but that's like
but that's yeah.
conventional wisdom and the reality, and you've gotta live within the reality of what the market
But
does.
maybe talk a little bit about your succession plan because you were on the board at the time of Resonate's exit, but you weren't the CEO anymore, right?
I was never the CEO. So, because remember when I left the White House, I started building 2 companies at the same time.
Right.
Resonate was a cash cow, and excuse me, Resonate was a cash suck for me at one point in my life, and the other one was the cash cow, and I was taking money from one
To
to
fund the
fund
other.
one and dumped it into the starting of Resonate, essentially. And I mean, in hindsight, like you never know. Like I probably like going in full time and leading it. I also didn't, as I mentioned, I didn't know how to read a piano. So
So
yeah,
you were never the CEO. You were kind of like the founder, but you always brought an outside.
we brought in a CEO named Brian Gerner very early, who's still there. He did an excellent job, but he had a lot of business experience, and so my partner John Brady and I, when we were building it, it was like I agree. Like, yeah, I don't, we need a CEO. Like, in hindsight, I'm not sure that's true. It worked out better for me to have a dual track,
Mhm.
have more opportunities for exit. And
Mhm.
so that was the right move. And it's not like I sat down and thought it through, but that's how it played out. And I'm glad and grateful for that. But I was on the board and early on I was very active for us. So
Of course.
and I sold a lot of the early business or helped sell a lot of the early business to get it launched, raised a bunch of the early money. But then the management team ran. And so then I was really more of a board member, then I was a board member who would play maybe a more active role than a lot of board members. And then certainly by the end, I was much more of a traditional board member. They had a whole team. They had incredibly experienced people.
Yeah. And the person that the CEO then stayed on with the company, like, so did he want to stay on? I imagine, like, I don't know if they handcuffed the management team. Obviously, they didn't handcuff you because you'd already exited yourself, sort of, which is nice.
Yeah, I mean, I didn't have a salary there. And so, there wasn't really anything to handcuff, but I can't speak for him. He is still there and is doing a great job. So
Uh,
I'm sure they made it worth his while.
that's cool.
They usually do if they want you to stay.
Yeah, exactly. Well, are there any other things or like things you wish you knew going into the exit process or the sale process, or that you would have done differently at the time?
I think for me, I mean, there was one point in the early, I mean, these are like mistakes you make. And again, like I don't look at the world like as like, well, I could have gotten more or this person this. Like it's not how I live my life. But in hindsight, I remember at one point when we were doing it to make room very in the very early stages. It's like so like there's 2 people found a company, we own 50%. Then we need to fund it. And my partners and at DVC and myself each put money in. Of course, there's more of them than me. And so to make it all work, at one point I wanted to put like 150,000 and someone said, can you just put in 125?
Hmm.
And because it just makes the math work for other people better. And
Mm. Mhm. Mhm. Yeah.
um, and 12 years later, like,
Uh-huh.
what money? And so, again, like that was at the time still probably the right decision, but I didn't even know what decision I was making.
Yeah. Like you didn't know what value you were giving up with that 25K
Right.
cut,
Yeah. And it's like I look back on that, like it's kind of humor. It's like very humorous. And like there's lots of opportunities to do lots of things. And so boring is the right way to approach these things. But being more educated is
Always, right? But it was still a successful.
very successful for me personally. I think one of the things about startups and being in early is that it's often very successful on a return basis for the early money. It's
Mhm.
the middle money that sometimes is awesome and sometimes does not do awesome.
Yeah, exactly.
Without going into like names and numbers, like the early money on a return basis did great. The middle money did like everybody got a return. So that was, and the late money did well, and so like that
The whole stack did well, basically.
well, this all everyone that made money.
Yeah,
Some people made more money than others on a
of course.
percentage basis.
Of course. But, I mean, sometimes it doesn't work out that way. Like sometimes the early investors get crushed. You get bad investors that come in later and they don't care and they want to sort of ruin the cap table and cut out all the returns of the early investors, or they want to set some preference that's so high that they get paid a ton of money before anybody gets,
Yeah.
anything else. And lots of ways it can go sideways. But in this case, it seems like overall a pretty successful waterfall.
Well, I think I can't take credit for the funds that came in. I had various meetings with various people over the years, but like, you know, a lot of that was management. One of the things I learned is like picking who your fund is matters. Now, sometimes you don't have a lot of options. You have to take a fund that's willing to fund you if you want the money. But if you have options, like really understanding who you're signing up to sit on your board, like that matters a lot because, you know, we have always had people, I would say at Resonate, especially that where I had maybe the most exposure to other funds, but now that I'm an LP in a bunch of people's funds, I see lots of different things. And
Oh, yeah.
those folks always did right by the management. They always did right by the founders. And they always considered everyone else. And like that's a pretty, I think, rare thing. And
I'm sure, especially.
now there's lots of good people who do that. And I think probably more people than not understand that to have a successful outcome, they do need to think about everybody else at the table. I mean, it doesn't work usually. Doesn't help if management leaves, doesn't help if management's angry. It doesn't help if the
Yeah.
founder, believe that you've tried to, hose them in some way. But there are plenty of people who don't the wrong way.
Right. Which to me is very short term thinking because if you're going to be an investor for life, it's a reputation that you're going to have and the way you treat people in those deals, other investors and the management and then, the stakeholders, it matters.
So we talked about DDC, which sold to Omnicom early in terms of, I built this book of business. I rolled it into DDC and, that was not a venture backed company. That was just built and it
It was
was
a cash flowing like consulting business.
flowing business. It had a tech business as well, a tech software and services business and some other like grassroots software, that did trade on a typical software multiple. But it was a portion of the business, like a third of the business, and the rest was generating services revenue, which, should be profitable, generally right away.
Right.
And so it was a totally different experience, but the sale process was also equally as difficult. When you sell to an Omnicom or a holding company and other funds, which looked at the business, you've got to really go through the same process. But
Mhm.
there's just a lot. It's a lot. In some ways, it's an easier sale because it's just management doing it. It's not. There's not all these other pieces and
All
personnel.
these others. Yeah. Personalities, right. Emotions in the room when you're trying to decide on who the buyer is and what the final terms are. Yeah. That's nice. And when did that company exit?
So we exited that in 24. So my trajectory was leave White House '07, start thinking about this, team up with John in late '07, and I'm talking about Resonate. At the time, I'd started taking client work on the side to pay my bills and did a couple political things, did a couple advocacy things. At that point, realized, you know, I really needed to build a shingle and did that. So when we hired a consultant to help us with Resonate and to get that off the ground. And there was a management team at DDC that was very experienced in technology. And then we hired the CEO, I think think in May of '09, maybe slightly before that, before we launched. We maybe launched in May of '09, so we hired him earlier. But I sold my book of business to DDC in 2011.
Okay.
And so then I was in there really full time, and then we sold it in, no, I'm sorry. It wasn't 2011. It was, God, I can't even remember this. It was maybe 10, 9,
Okay.
10, 11. And then we sold it in 2014.
Okay.
But
Yeah.
we have an earnout. So then I was locked. Then I had the handcuffs. I know what that's like as well.
Yeah. How long were you there then after the post exit?
So the deal was finalized in 2017 is when the earnout was done. And we actually had a 4-year earnout, but we negotiated for time. It took a long time to get the deal done. We're able to start the clock.
When you started the deal?
Started-
Yeah.
Well, it
Yeah.
ended up
Smart.
being
That's
like
smart.
3 more years, essentially. And so I left at the end of 2018. I stayed 1 extra year and then left at the end of 2018.
Okay. That's interesting. And so in both scenarios, like in one scenario it was venture backed, it sold just a regular exit. You weren't there was no handcuffs, you weren't involved. The other case, you were there for 3, 4 more years. Is there anything you wish you knew in that scenario where you've had an earnout, like the way the deal was structured? Because that would have been I guess, probably the first time you were involved in an earnout type of deal.
Well, I think it's different for different regions of the country. I think in Washington, you really want to time these things around as best as you can predict what the political makeup is going to be. And
Mm,
obviously, you don't know who's going to win an election, but presidential years are always big years in politics, and there's always a lot of activity in this town. Then the new administration, if there's a new administration, advocacy is very robust. And so we sort of accidentally timed that right. And it really ended up, at one point we did really well in the year now. We always exceeded numbers, but at one point, like we had a very big deal come in, like at really good timing for us that really these deals get structured. There's kickers usually. And if you exceed numbers, you do a little better. And they're in many ways way more complicated than a venture backed deal where they're like, here's your $100 million for your company. And of course,
right.
it's legal work, but there's not all these triggers. And you might make this much, but you might not make this much. And if you do this, and if you have this piece over here, and they're more complicated. It was a
Yeah.
more complicated deal, at least for people taking the cut of the deal.
So I guess final thoughts, any other takeaways or I guess advice you would give to someone going through a transaction themselves for the first time?
I would say really is like trust your instinct. I mean, it's just like it's so easy to like get wrapped up into conventional thinking or also to be caught up in what somebody else did or what the average is. And like every business is different. Every personality is different. Every fund is different. And like it's a unique constellation that like comes together to make it work. And it's hard to compare one deal to the next. And be thankful for what you have because not many people sell their businesses. Most businesses fail.
Most businesses fail. Most exits are not positive, and I think nobody realizes that. And also, each type of exit, to your point, is very different. They're all different. That's why we wanted to focus this season on exits so that people can understand how different they all are and what the scenarios are that eventually play out. So, anyway, but thank you, Sarah. This was super informative, and I think it'll be great for our audience to hear.
Well, my pleasure. I enjoyed talking.